Ladies and gentlemen, good day and welcome to Jubilant Ingrevia Limited's earnings conference call for the quarter and half year ended September 30th, 2022. As a reminder, all participant lines will be in listen-only mode, and anyone who wishes to ask a question may enter star and one on their touchtone phone. To remove yourself from the question queue, you may enter star and two. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Singh Taneja, Director, Investor Relations, Jubilant Ingrevia Limited. Thank you, and over to you, sir.
Thank you, Aman. Good evening, everyone. Thank you for being with us on our quarter 2 and a half year of financial year 2023 earnings conference call of Jubilant Ingrevia Limited. I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release and result presentation that has been shared on our website. On the call today, we have Mr. Shyam Bhartia, Chairman, Mr. Hari Bhartia, Co-Chairman, Mr. Rajesh Srivastava, CEO and Managing Director, Mr. Prakash Chandra Bisht, CFO, Jubilant Ingrevia Limited, and Mr. Arvind Chokhani, Group CFO, Jubilant Bhartia Group. I now invite Mr. Shyam Bhartia to share his comments, please.
Thank you, Praveen. A very good evening to everyone. Thank you for joining us on Q2 FY22 earnings conference call of Jubilant Ingrevia Limited. We are pleased to announce stable operational and financial performance during the quarter under review, despite continuing headwinds on account of high energy costs during the current financial year. Our specialty chemical business revenue grew 63% year-on-year on account of better demand across all products in the segment. Margins are impacted mainly on account of higher cost of energy due to restriction on contracted coal supplies. While we expect the coal supply to normalize soon, we also continue to explore alternative energy solutions for future. In nutrition and health solution business, flu situation in US and Europe is normalizing. However, demand for B3 continued to be suppressed owing to post-flu impact and excess inventory across the value chain. Our focus on niche segments like food and cosmetic is showing positive results, and we continue to increase our revenue share in this segment. We also believe that the demand challenges of vitamin B3 are short-term. We continue to improve market share in our animal nutrition business of vitamin B4 and other branded premix products. Our chemical intermediate business continues to witness strong demand resulting in volume growth. Business continued to improve its leadership position in acetic anhydride in domestic and international market. Revenue impact year-on-year basis was primarily driven by lower prices of feedstock, leading to lower sales prices of ethyl acetate and acetic anhydride. We believe that the Jubilant Ingrevia Limited is well positioned to deliver robust growth in the future, backed by its comprehensive growth plan for its growth projects. The performance in the coming quarter will be driven by higher share from specialty chemicals, where company is scaling its capacity and capability. Nutrition and health solution, where the company is enhancing its value-added range of products in chemical intermediate segments, where our core emphasis is on enhancing healthy volume contributions. With this, now I hand over to Rajesh to discuss about the business in detail. Before that, on the behalf of the entire team Jubilant, we wish our investors and everyone present on this call a very joyful, peaceful, safe and very happy Diwali.
Thank you, Mr. Bhartia. A very good evening to all of you. At the outset, let me welcome you all for joining us today for Q2 FY23 investor call of Jubilant Ingrevia Limited. I sincerely hope that you and your loved ones are keeping very well. Let me now take you through the financials and operational performance of Jubilant Ingrevia Limited for the quarter 2. Revenue during the quarter was 1,304 crore. Overall revenue grew by 7% year-on-year basis, mainly on account of higher sales performance by specialty chemical business. Nutrition and health solution business continue to witness lower demand owing to post-flu impact and excess inventory situation across the value chain, coupled with short-term demand impact in Europe due to ongoing geopolitical situation. Chemical intermediate volume have further grown while revenue impacted mainly on account of lower prices of key raw material, that is acetic acid. EBITDA is at 160 crore. Higher input cost due to non-availability of contracted coal coupled with lower volume offtake of niacinamide has impacted EBITDA, while specialty chemical and chemical intermediate volumes have grown significantly. We continue to focus on improving efficiencies using various business excellence tools and techniques to maintain competitiveness. Sustainability continues to be our core focus area for us, and during the quarter we successfully achieved EcoVadis CSA assessment score of 93 percentile with gold rating. Now let me take you through the updates on all our 3 business segments. Specialty chemicals. Revenue of specialty chemical business was rupees 480 crore and EBITDA was rupees 77 crore during the quarter. Specialty chemicals revenue grew by 63% on year-on basis, driven by higher volume across product segments. Share of revenue to customers having agrochemical and end use increased during the quarter. We also witnessed healthy demand in our oil field chemicals. Our CDMO pipeline is healthy and progressing positively. Our new GMP and non-GMP facilities, which are expected to be ready during current quarter, that is Q3 FY23, will help us in capturing growing demand of CDMO projects. We observed a positive traction of demand for our other specialty chemicals also from both domestic as well as international customers due to China Plus One strategy from all our global customers. Demand of pyridine continued to be strong during the quarter. Our business team have been successful to pass on most of the raw material costs and also partially increased energy costs as well. Specialty chemical segment's absolute EBITDA increased by 8% on the back of higher volume. In spite of significantly improved volumes in the segment, relative increase in absolute EBITDA and EBITDA margin are lower, mainly due to higher cost of coal. Nutrition and health solution business. Nutrition business revenue was at rupees 114 crore during the quarter. Nutritional business revenue de-grew by 36% on account of lower demand owing to post-flu impact and excess inventory situation across the value chain, coupled with the short-term demand impact in Europe due to ongoing geopolitical situation. However, share for food and cosmetic in segment revenue grew on year-on-year basis. EBITDA and EBITDA margin also declined mainly on account of lower sales volumes of niacinamide. Flu situation in EU and America regions have improved. However, we expect that demand situation may normalize towards the end of Q3 or beginning of Q4. Demand of vitamin B3 is also witnessing short-term impact in Europe due to ongoing geopolitical situation. We expect these challenges to be short-term and remain positive on the prospects of nutrition business in the medium term, and we continue to maintain our leadership position in global market. Further, we continue to improve our revenue share of niacinamide in niche segments like food and cosmetic on year-on-year basis. Our animal nutrition business has improved market share of vitamin B4 and other branded premix products. Chemical intermediate business. Revenue from chemical intermediate segment was rupees 710 crore, down by 5% on year-on-year basis, and EBITDA stood at rupees 77 crore. Revenue degrowth was driven mainly on account of lower price of key raw material, that is acetic acid. However, acetic anhydride witnessed double-digit volume growth year-on-year basis. Also, revenue from Europe have gone up significantly year-on-year basis. EBITDA was lower due to stock impact on lower feedstock prices and lower demand of ethyl acetate. We continue to in domestic market leadership for acetic anhydride and further strengthening our position in international market. We remain the key strategic supplier for select customers of ethyl acetate. Our upcoming acetic anhydride plant at Bharuch is under construction and is expected to be ready during Q4 FY23. Outlook and growth capex plans. We expect our H2 performance to be better than H1, assuming no unexpected adverse situation. We expect overall healthy revenue growth during FY23, led by volume growth in specialty chemicals and chemical intermediate segments. Commissioning of new capex during H2 is likely to aid the growth. We are fully committed towards our growth aspiration, and we are excited to realize the emerging opportunities through our ongoing growth capex plan of rupees 2,050 crore during FY22 to FY25 period. We continue our efforts towards improving our revenue mix of specialty and nutrition segment to 65% by FY27 from 46% in FY22, and we believe this to be a key driver for overall margin improvements. With this, I now hand over to Prakash to discuss the financials, and I would like to wish you all very happy and prosperous Diwali for you and your family. Thank you.
Thank you, Rajesh. A very good evening to everyone, and thank you for joining us on Q2 FY22 earnings conference call. I would now highlight the company's financial performance during the quarter and half year ended 30th September 2022. Revenue from operations during Q2 FY23 was at 1,304 crores as compared with 1,223 crores in Q2 last year, registering a growth of 7% on YOY basis. Similarly, revenue from operations during the H1 FY23 was at 2,469 crores as compared with rupees 2,367 crores in half year last year, registering a growth of 4% on year-on-year basis. The EBITDA during the quarter was rupees 160 crores as compared with 202 crores in Q2 FY22, witnessing a decline of 21% on year-on-year basis, and the margins stood at 12.3% in Q2 FY23 as against 16.5% in Q2 FY22. The drop in year-on-year EBITDA margin is mainly on account of high energy costs due to non-availability of contracted coal, coupled with the lower volume of take of vitamin B3. Similarly, EBITDA for H1 FY23 was at 311 crores as compared with 490 crores during H1 FY22, and margins were at 12.6% during H1 FY23 as compared with 20.7% for the same period last year. The EBITDA for H1 FY23 is impacted on account of chemical intermediates segments EBITDA normalization, lower volume of take of vitamin B3, coupled with higher input cost impact in the specialty chemical business due to non-availability of contracted coal. Depreciation and amortization expenses during the quarter were at 31 crore. Finance cost during the quarter was at 5.1 crore versus 7.16 crore in FY22 on account of repayment of high-cost long-term loans and lower average utilization of debt. Net debt was at 282 crores at the end of Q2 FY23, and the average blended interest rate for Q2 FY23 was at 5.84%. During the quarter, India Ratings upgraded its credit rating of the long-term debt of the company to AA+ stable from earlier AA stable. The tax expenses for Q2 FY23 were at 40 crores. The company would continue to remain under the old tax regime during FY23 and the ETR is expected to remain in the range of 31 to 32%. PAT during the quarter was at 84 crores as against 111 crores in Q2 FY22, witnessing a decline of 24% year-on-year due to lower EBITDA. Similarly, PAT for H1 FY22 was at 164 crores as against 279 crore PAT in H1 FY21. Net debt to EBITDA ratio was at 0.41 times on the basis of trailing 12 months EBITDA. The net working capital percentage and number of days of working capital for Q2 FY23 on the basis of trailing 12 months turnover was at 17.9% and 65 days respectively. Increase in net working capital is driven by short-term strategic decision of inventory building of certain products and temporary reduction in creditors due to procurement of domestic ethanol. The capital expenditure during the quarter was approximately 110 crores. With this, I would like to conclude our opening remarks. We will now be happy to address any questions that you may have.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Tarang Agrawal from Old Bridge Capital. Please go ahead.
Hello, sir. Good evening, and thank you for your time. So 4 questions from my side. First, on the chemical intermediates business, for H1, was there any inventory loss? If so, if you could tell us. That's the first question. The following 3 questions are related to specialty chemicals. One, if you could give us the volume growth on the specialties chemicals business for Q2. Second, just trying to understand how long is the coal issue probably going to continue, and in your conversations with your customers, if you see a potential for you to be able to pass on this cost, because essentially it's a specialty chemicals business, so one would presume that you would have a strong ability to do so. And third, in the pyridine space, would you have any peers operating out of Europe, and given the crisis that we're witnessing there, therefore a potential for you to probably garner more market share? That's it from me. Thank you.
Tarun, on your first question on chemical intermediate Q2 impact, as you can see, the acetic acid prices at the quarter 1 end was $745, and this quarter we ended with $620. So you can fairly assume there is a reduction of $120, which actually makes our 20-day stock valuation reduction on a gradual basis of during the quarter. So there is an impact. On your specialty chemical 3 questions on volume, yes, we have grown volume as we have explained that out of 63% or 64% growth in specialty chemical revenue, close to 42-43% has come from volume, and rest is from price. So of course the entire growth of specialty chemical, more than 65% of this growth is contributed with the volume growth. On second question of coal issue, it is so difficult to explain by when we will be over, but looking at the discussions which we are having with the government and we are having with the collieries, we are very, very confident that this issue has to be behind us by end of this quarter or beginning of next quarter. That is certainly there. Having said so, as a company, we are taking a long-term view of this situation to de-risk ourselves in future, and we are making a strategy to really minimize this impact in future at all if happens. But it takes time, so that will be happening, let's say, in 2-3 quarters, not immediately. So one is that coal impact will be behind us by, let's say, Q4. But overall, for future, we are taking strategies to minimize this impact, even though if it happens. On pyridine question, There is no one in the Europe who is competing with us in pyridine. The only competitors for us in pyridine and derivatives are sitting in China. And as you know, the tendency of now European and US customer to source the specialty chemical more from India, favorable situation is also making an impact on our pyridine and derivative business, because that's a positive trend we continue. Hope I have replied to your question.
So just one more. Sir, in terms of your ability to pass on the cost push that you're seeing in power and fuel, is it a call that you've taken that maybe perhaps you see it as transient, therefore not having a conversation with your customer, or you are somewhere limited in your ability to pass on the cost push?
No. So if you see the coal impact to us in Q1 plus Q2 total is in the range of 160 to 180 crore rupees. Now, out of this, I am sure you can see that we have not got impacted to this extent in Q1 plus Q2. So there is a great amount of effort our business team has made to pass on the cost of coal impact. However, since this impact is not in general for everybody, obviously it is difficult for our products to take 100% pass on. So you are right. We are not hesitant to talk. We have been talking to our customer, and they have been very, very favorable on our request. And to some extent, they are in a position to pass on those costs to us, but not, of course, 100%.
Okay. Thank you, sir. All the best.
Thank you.
Thank you. Our next question is from the line of Malay Samir from Breakthroughs in Stock Market. Please go ahead.
Thank you very much, sir, for giving me a chance to ask a few questions. My first one is, in quarter one, we had taken a hit of about 40 crores on the fuel as well as inventory losses on acetic acid. So how much would that 40 crore compare in the current quarter? That's my first question. The second question is on the commentary that you made, that you're looking at alternate sources for energy. That somehow gives a feeling that we are not sure of getting FSA coal in future like we did in the past. And therefore, the third question is that if partial FSA coal and partial coming from imports or e-auctions become the norm in FY24 too, then what is the kind of hit, incrementally do you expect from these new situations?
Let me take your second question first, because that's very straightforward. First of all, you should know that this contract is between us and government. So this is absolutely unlikely that we will not get FSA coal. It is definitely the deferment, not the cancelling. And we have a contract for 5 years. So it's absolutely not possible that we will not get. What I said that we are making alternate arrangement is not to the extent of FSA. We said we will be definitely working on the energy cost reduction overall. Now that is something which will reduce overall impact, but I'm not saying that we will stop buying coal or we will not get a coal. I hope I have clarified this. So please don't get that impression that we have any even thinking about that we will not get FSA coal. So that is a clear answer for your question 2. Now your question 1, the impact which you said 40 crore Q1 is currently representing to the tune of almost 55 to 60 crore in Q2.
Okay. So my first question, which you've answered very clearly and specifically, sir, was definitely on the participation from FSA coal and other means. I certainly didn't mean that we would be eliminating FSA and going on other means. So, but that has been taken by you very, very well. Now, since this hit on coal and acetic acid, inventory losses have increased from 40 to 55 crores. Can you give us a guidance in future, so that we can build our models accordingly?
Yeah. So what we can give today guidance is, so far the FSA has not been released. We are expecting and we are hearing from the corridors of government as well as collieries that from 1st December they are expected to open. But if that does not happen by any chance, absolutely from 1st January it will get open. Because even government is now under pressure to supply it to the industry. There is a lot of pressure from various industries for FSA coal to start. I am hoping it should be from 1st of December, but in worst situation, 1st of January certainly. So be definitely clear about it.
Yeah. So, sir, in the last conference call, we had somehow hinted that the FSA coal will start in, by about the 1st of September. And it didn't happen that way, and I know it is due to backlogs at the part of the government. So can we sort of draw a communication to the investors and potential investors where we keep them updated on a regular basis, maybe a monthly basis or something, where we update them about the current situations?
Yeah, we are doing it continuously. As and when we have any investor discussion, calls, communication, we are updating our current situation. And this is something which is known to everybody, because we are not the only sufferer of FSA. You talk to any industry who consumes FSA. This is a known thing, but you are right. Whenever we are meeting investors, we are meeting anyone, we are communicating very clearly.
Okay. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Pratik Kothari from Unique Portfolio Managers. Please go ahead.
Hi, good evening, sir, and season's greetings to you and your team. Sir, a couple of data points. First, if you can share you have shared the volume numbers for specialty, but for the health and nutrition and intermediate, if you can share that, please.
Yeah, so if you see our presentation, health and nutrition, our niacinamide volume has degrown by 40% over last year. On chemical intermediate segment, our volumes have grown almost 10 to 12%, 10% by volume growth. However, there is a reduction of price impact to our profitability. So that's about 15%. So there is a volume growth, but you don't see that impact in our profitability because of the acetic acid price impact in the inventory.
Okay. So this the operating profits that we see a dip, because what we used to do, I believe the pricing is based on per ton basis and not on a percentage basis. The operating EBITDA drop that we see would be because of the acetic prices, that the inventory hit that we would have to take.
Absolutely. Absolutely. In fact, yeah, because, since we are this business runs with per ton basis, so since our volumes are growing, obviously the absolute EBITDA is growing, but you don't see the full impact because of this impact of acetic acid. You are very right.
Fair enough, sir.
And once this acetic acid price will normalize, you will see the normalized EBITDA of chemical intermediate.
Fair enough. Fair enough, sir. Then my second question is on other expenses. I mean, excluding your fuel and power, in first half from 220 crores, it has gone up to about 300 crores. So you can throw some light, what is this regarding?
Yeah, Pratik, so other expenses, the way the SEBI format is, so it is not all fixed expenses. This includes many variable expenses also. So the expenses which has gone up, primarily it is on account of freight. And we also have increased our tolling business, which is outside tolling. So these are the two expenses which has gone up. So this increase is mainly on account of freight and incremental tolling.
Fair enough. And so my last question, given the volatility, etc., there are a lot of, in numbers, we have seen a lot of it on the coal, fuel prices, some inventory write-off. But any positives that you can share which are not reflected in the numbers currently in terms of the trajectory, the capex that we had planned?
Yeah. So the one of the best positive which you can observe is what we have been telling everybody that as a business we are standing very strong. Our volumes are growing, specifically on our specialty side. What we have been talking is turning out to be the reality, which will continue, and that's what will bring both in terms of volume achievement as well as profitability. So that is happening very positively. On chemical intermediate side, the plant which we constructed of acetic anhydride in 2020 is running now in a very high level of capacity, and that's why we are building up the new plant. So that capex which we put up was a very good decision at the right time. So those values are being realized. You can see our overall chemical intermediate performance of 2 years before and now has significantly improved, and this will continue to improve because we are going to utilize this plant fully, as well as this Q4 we will get the additional plant. So chemical intermediate business continue to grow volumes as well as our revenue and EBITDA profitability situation. The temporary situation, the two realities which we are talking is very short term, which is the coal price increase, and secondly is the temporary impact of our vitamin B3 business. Rest all, the business is really standing very strong, as you can see with the results.
Great. Thank you, sir, and all the best.
Thank you. The next question is from the line of Rohan Gupta from Nova. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity. Sir, couple of questions. So first is on clarifications on our development on decadine and CDMO projects. Where our decadine projects have reached and what kind of utilization the plant is operating right now?
Rohan, our diketene, as I explained in the last call also, fortunately our plant have come out very successfully both on capacity as well as on cost and quality. The challenge which we explained on diketene was temporary, where the demand from one of our large customer in India has been very low because of some unforeseen situation, which is going to be normal situation by Q4. However, your specific question, I think currently we are utilizing our facility to the tune of 40 to 50%, and we are very confident come Q4 we will be touching 80 to 100% of our capacity of diketene.
Okay, so sir, this is basically specific to the UPL, that is the agrochemical consumption which has been impacted. That is what is affecting our decadine consumption. Am I right, sir?
Yeah, that is correct. And one of the industry, which is dye industry and packing industry, is also not doing as great as it should be doing, which also is expected to normalize Q4 or Q1 next year.
So with the 40 to 50% utilization level in diketene, are we, sir, completely dependent on domestic market consumption, or have we already started exploring the export market opportunities?
We have already started exploring export market and we have a great success there also, but as of now our major volumes are domestic.
Okay.
Because export market will take little time for getting approval at commercial level, etc., which we have told earlier also.
And sir, this is primarily for the, I think, 3 derivatives of diketene where we are relying right now, and what is about the further expansion in the product line of diketene based derivatives?
It stands as it is what we explained last time, that phase 2 of diketene we will bring up sometime next year, that is FY24 end, and that will bring another 3 to 4 products. Then the phase 3 will come subsequently. So that is on track. That is happening. The products are clear from R&D. We are doing little bit of detail engineering part of it, and then we will bring up the capex next year.
Okay. Sir, second question is on specialty chemical with such a strong volume growth which we have delivered up to 40 to 45% in the current quarter. So what is this growth driver and what is the growth coming from the pyridine derivatives and what is from the non-pyridine based business?
So in specialty chemical, our major business is pyridine and pyridine derivative, except for the diketene and CDMO business. So you can say that the growth is primarily coming from pyridine and pyridine derivatives.
So in the pyridine derivatives, if I understand rightly, the market would not have been growing so much, and we already have such a strong leadership position in many pyridine derivatives. Almost 12 to 13, we have almost 60 to 80% market share. So the the key growth driver of this in pyridine derivatives, which you're talking about 40%, it's basically driven from where we are gaining market share.
So you are right. In some of our products, we have 50 to 60% market share, but there are other products where we are capturing more market share because of China Plus situation now globally. And lastly, we have continuously introducing new products in pyridine derivatives, which also, because we are expanding non-GMP facilities. So all these new plants, new investments which we are making in specialty chemical will also bring us revenue both from new products as well as from the existing product, more markets here. So we have not achieved, let's say, 70 or 80% market share in each of our products. So there is enough room for us to grow within the pyridine and pyridine derivatives also.
Okay.
And overall market demand is also growing. So though we have a share, but since the market is growing, that also gives us an opportunity to take our leadership position to further stronger way.
And so just last from my side on vitamin B3 and the business which has been impacted because of the flu. So you mentioned that the flu scenario is over now, but the market has a high inventory. So you see that the situation in Europe and the demand will improve by Q4, or it can take some more time because of the high inventory in the system.
So usually what happens, Rohan, when this kind of situation of flu happens, that in poultry people cull the birds, and once the birds are culled, it takes almost 3 to 4 months for the farms to start consuming the same volumes which they used to consume. So after 3 to 4 months, of course, this inventory situation, because suppliers have inventory, so overall 5 to 6 months it takes. So Q4, we see that great extent the situation will improve, but from Q1 we are certain that situation will become normal.
Okay, so that's it from my side. Thank you.
Thank you. The next question is from the line of Nitesh Dhoot from Prabhudas Lilladher. Please go ahead.
Yeah, hi sir. Good evening. Thank you for the opportunity. So the first question is on the commodity, on the chemical intermediates segment. So here have the per kg margins, the spreads normalized for ethyl acetate and acetic anhydride, or is there any further normalization expected?
So on anhydride, as I said earlier also, our per kg realization is improving because we are improving our volumes, we are improving our share with the customers, we are increasing our business to more international markets. So overall, our per kg margins are improving. So as we will catch up the volume, you will see the overall profitability of chemical intermediate business improving, which is happening. If you see last 1.5 years, this has been improving. And since we are increasing our capacity because of the demand, of course volume will go. So it will be a good impact of both per kilo impact as well as volume.
Sure. So and what's the current capacity utilization levels, both in anhydride as well as in ethyl acetate?
On anhydride, we are fairly at a range of 70 to 80% overall in general. Some of the plants are more than 90-92%, some of the plants are lower. But in next couple of quarters, the volume situation is definitely showing us that the utilization is going to significantly improve. And once we bring the new plant, probably we will be in a position to add more volume.
Sure. And so what would be the reason behind the lower demand for ethyl acetate?
So ethyl acetate, the lower demand is happening because the extra pressure at China to produce ethyl acetate and dump in the European market, which is slowly now improving. So that is one. And secondly, in India, the demand in packaging industry is down. As you know, packaging is not doing as well. So that is the reason. But of late, we are also seeing a positive trend of ethyl acetate as well. So hopefully in next couple of months, ethyl acetate will improve. But as you know, ethyl acetate, we are very focused on only select customers where we have a good quality requirement of products. So we are actually not really focusing on large volume because this is not a product where we feel that we can make good money.
Sure. But what would be the capacity utilizations there on ethyl acetate?
In general, if you see, we are at about 60 to 70%. But remember, these capacities are multi-purpose. So we can produce some other products as well, which are the value-added products, which we are launching one by one. Like we have done propionic anhydride, we are utilizing the existing capacities with some debottlenecking, etc. So new products we are working on to take care of this capacity utilization. So they are not sitting idle.
All right. Okay. And sir, another one would be on the balance sheet on the debt levels which have increased. So net debt has increased to 280 crores. So where do we expect the debt to peak, keeping in mind the capexes that we have?
So if you see the current situation, again on the debt side, it is very short term because our profitability has been lower and of course the capex is going very strong. But we have enough headroom for our short-term borrowing. So for time being, for few months, probably we'll go for short-term borrowing. And we are expecting H2 performance to improve significantly. And we see that we will be in a position to bring back the overall borrowing situation by end of this year to a controlled situation. That should not be a concern area at all.
Mitesh, just to add on to what Rajesh said, you would see that the increase in borrowing is only to fund the working capital increase. So
yes, sir. So what was the exact reason behind the working capital increase? I had missed out the earlier part. So if you can just repeat once.
Yeah, it's just two key reasons. One is that we have taken two products as a strategic decision to improve inventory to gain in market share and profitability in next 2 quarters. So it's a short-term event of 5 to 6 months. And second, as you can see that our creditors have increased because we were getting a better price alcohol in domestic market where the creditors are lower. So therefore it is very short-term. Coming December or January, we will be back with the normalized creditors. So let's say in 3-4 months, and that's why I'm saying that 3-4 months you will see the normal working capital, which we have been at the range of 15 to 16%.
Sure. This is helpful, sir. Thank you so much and all the best. And a very happy Diwali to the entire team.
Thank you. Same to you.
Thank you. Our next question is from the line of Harsh Shah from Dimensional Securities. Please go ahead.
Good afternoon, sir. So if I understand this correctly, the power and fuel costs, which has increased to nearly 16% of sales. So earlier it used to be around 8.5%. Eventually, when the situation improves, so could be 2, 3, 4 months down the line. So do we expect this to revert back to 8 to 9% of sales, which was the normalized range? So that would be an alpha of 7-8% from where we are standing currently at 12% EBITDA margin. So 6 to 7% from here, then we are talking about increasing contribution from the specialty chemical business. And then we are also talking about phasing out of the inventory loss, which we are seeing in chemical intermediary space. So taking impact of everything, so from the current level of 12% EBITDA, do you think there can be alpha generation of around 9-10% over next year or so if all these factors start reversing?
So there are two things. Let me first address your point on EBITDA level. So if you see the Q1 plus Q2, the overall impact of coal is in the range of 140 crore. Now, if you add this and add our loss of niacinamide business contribution, this itself, two things itself brings us on H1 basis to the close to 20% EBITDA. Now, having said so, what you are comparing from last year, the cost of fuel and energy, particularly the coal, has two impacts. One is the overall price increase of coal. Earlier, we used to buy coal from import market at 5,000 to 6,000 rupees per ton, which has overall increased to the level of 12,000 rupees a ton. So that has gone up for everyone. That I don't think we have any visibility today to tell you whether it will come down. The second impact on that percentage is our FSA coal. Now that FSA coal, as I explained in the last question also, we are very sure that the situation has to come to normal definitely by Q4 of this year. So that impact of overall increase of coal is for everybody, and we have already recovered in our pricing. What we are not in a position to recover 100% is the difference of FSA versus the normal coal.
Okay, understood. So currently we are receiving no procurement from the FSA coal.
Yeah. So nobody gets. It's not only we. Nobody is getting the FSA coal.
So when the situation normalizes, what percent would come from FSA and how much would we buy from the market once situation normalizes?
So that's what I said, that the overall cost impact of FSA coal for Q1 and Q2 is about 140 crore. So that will be a normal situation we will achieve in a normal FSA availability.
Okay, sure, understood. And for niacinamide, have you seen the realizations coming off sharply because of the inventory situation?
Yeah. So niacinamide volumes are also lower, even realization is also lower, of course, because the inventories are high, and both have to improve.
And how much are the realizations lower compared to FY22 level?
I think it is in the range of about 12 to 14%.
12 to 14%.
On pricing.
Thank you so much, and understood. Thank you so much. Wishing you all a very happy Diwali.
Thank you.
The next question is from the line of Neelam Saha from Ventura Securities Limited. Please go ahead.
Am I audible?
Yes, Neelam, you are audible.
Yeah. Hi, sir. So in your investor presentation, you have mentioned that in the couple of coming years, your capacity of all the segments is going to increase by around 40%. And you have also mentioned that after the current capex project is done, your constitution of revenue will change and chemical intermediates will constitute from now 60% around to around 35% at that time. So I want to understand how that change is going to happen, whether you're going to change your capacity utilization of different segments, and also if you can give a further breakdown of nutrition and specialty chemicals who are going to constitute 60% of your revenue at that time.
Yeah, so the answer to your first question is because most of our new growth capex investments are happening on specialty chemical and nutrition side. All those new capexes and new investments will bring additional revenues which will change the entire revenue profile of specialty and nutrition. On chemical intermediate side, as you can see, our major capex is on anhydride and on green acetic acid. Rest all growth capexes are in the specialty and nutrition side, and therefore the change in mix will happen with that. Your second question is that on specialty chemical, our existing performance itself is showing that our growth is now in line with what we have been talking. So definitely it will be possible by FY25, we have shown in our presentation, we will achieve.
So out of that 60%, how much will be in specialty and how much in nutrition? Would you be able to get that breakdown?
As of now, I don't have exact number. I can come back to you later, please.
Okay. And my second question is, I have a few questions related to the financials. So what is your current inventory days And you also mentioned that your other expenses, some part of it is variable and some fixed. If you can give a average percentage of that. And also in your revenue, you have some inter-segment revenue part of it. I would also like to know how that, or what it depends on. Like, is it a certain percentage of your revenue or certain percentage of, say, chemical intermediate? I'd like to know that too.
So, Neelam, the inventory days are 65. What you see in the segmental sale is the merchant revenue. It does not include the inter-segmental revenue. So it's all merchant revenue, which you are seeing as a segmental revenue. I missed your third question. What was that?
Other expenses part of it, if you can give a breakdown of variable and fixed, leaving the power cost.
So other expenses includes all the rest of the expenses, because at the way the SEBI format has been designed, you have to show material separately, employee cost separately, and then actually you can put everything else in the other expenses.
What is there?
So other expenses includes everything else. So it has repair and maintenance, freight and forwarding. It has so processing charges, travel expenses, all admin costs, selling and administration, all other expenses are included in that. I would request you, if the simple way is, our annual report has been released recently. If you would see that annual report in the manufacturing and other expenses, you will get the full detail of these expenses, the nature of these expenses. The same expenses are coming here as well.
Okay, understood.
Neelam, is the question answered?
Yeah.
Thank you. With the next question, that is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, hi sir. Thank you for taking my question. So some of my questions are already answered. But just one clarity. As you say that specialty chemical volume growth was somewhere 42%. So this is Y-on-Y basis, right?
That's right.
Yes.
So this specialty chemical definitely includes our dieting business also. So just wanted, if we get the growth number excluding this dieting business, that would be helpful.
Honestly speaking, as we just explained to you in last questions, that diketene business right now is not generating significant revenue. So if 40% capacity is utilized, you can assume what is the revenue we are generating. So if you exclude that also, you might even just get 2 or 3% reduction in revenue. But still the growth in other products are much higher.
Okay. Secondly, on acetic anhydride, as you again said here that the volumes were much higher. So just wanted to understand from which region we get the maximum traction and how much these volumes are sustainable going forward.
So this increase is across. Let me explain to you. So domestic market as such is growing. A lot of new products customer have started manufacturing in India, which were never produced. So overall volume requirement of domestic market has gone up. So we are capturing, as you know, I explained in the last calls also that paracetamol, now India is the leader in producing paracetamol. Earlier, China used to lead that production. So India is capturing more and more market share in global market. Same is the situation for agrochemicals. Same is the situation for any other end use of anhydride. And also in international market, we are capturing our market share because Europe, as in India, European demands have also gone up and no other competitor have increased capacity. So we have affinity for increasing our volumes in Europe. Having said so, even Southeast Asia demand, we are capturing now all the increased demands globally. So I would say it's across the region, not single region, because globally nobody is increasing capacity. Jubilant is the only company where we have increased the capacity of anhydride 2 years before, and this plant which will come up in Q4 will be the only capacity expansion of anhydride in the global situation. And there, as I explained in the last call also, that one of the new use which have come in anhydride uses, which is wood acetylation, that in Europe is going up, demand is going up. So all that is actually really mixing up in our performance of anhydride, which we have been having the clue in the past, and that's the reason we took this call of capacity expansion.
Okay. That's helpful. And lastly, on the raw material procurement, as I think, and we have started getting ethanol from the domestic side, largely from this quarter. So apart from that, how has been the procurement for ethanol, methanol, and any other major raw material parts? And where the prices we are seeing there?
Ethanol, we are still the major importer from US and Brazil. This domestic procurement is very small volume, and that happens on the spot availability situation. So sometimes if the import prices are higher and domestic supplier is sometimes trying to take the volumes and he doesn't have any other volume to sell, we buy, and that if we get little cheaper. But that's not our strategic purchase. Our strategic purchase is imported alcohol. Coming to acetic acid and methanol, we have been saying we have a strategic procurement of acetic acid and methanol from global supplier. We have multiple suppliers. We have from China, we have from Europe, we have from US, we have from Asia. So that we keep doing from our relationship with multiple suppliers, both methanol and acetic acid.
Okay. That's all from my side, sir. Thank you and happy Diwali, sir.
Thank you.
Thank you. The next question is on the line of Naresh Vaswani from Samiksha Capital. Please go ahead.
Yeah, hi, sir. Sir, first question on this coal situation, this FSA coal. So while you said that we have a 5-year contract, I wanted to understand the pricing phenomena. So how often does the price gets revised? And second question is on the CDMO part of your business. So in the annual report, you have highlighted that you have 5 molecules in the pharma and 2 in the agro. So wanted to understand whether these 7 molecules will start generating revenues when the new capacities come online in the next quarter, and what portion of your capacities, your dedicated capacities, will be utilized for these 7 molecules?
So on FSA coal, prices are fixed for 5 years. It is auctioned price once, and it is fixed for 5 years. So that's the benefit. So there is no negotiation, there is no change in price for 5 years. On your second question on CDMO, there is continuous working to improve our pipeline. We explained in earlier calls that we had 5 products at commercial scale in pharma and 2 products at commercial scale in agro. That numbers have changed now. We have now 7 products at commercial scales in pharma and now about 3 products in agrochemical. Now, in addition to this, we have almost 10 to 12 products in pipeline, which are under development with the customer with pharma, and there are about 3 to 4 products in agrochemical. So this is a continuous exercise to offer these new products to customer, and as and when customers' product gets commercialized, we start realizing our revenue. Now, in your last question, that how much we are utilizing capacity, very difficult to give you in percentage of the overall capacity. But let me tell you, we are fully utilized all our dedicated CDMO capacities, and this is the reason the 2 non-GMP capacities are getting ready in this quarter, which again will give us the revenue increase of CDMO business, and the demand increase of volumes will be serviced from those new capacities. And also GMP, when we will be ready this quarter, will be utilized for the increased volumes of the existing products, as well as these new products which we have recently commercialized.
So, sir, you expect that given the strong pipeline you have, these capacities would get utilized within a short period of time, within 2 quarters, let's say?
Absolutely, you are very right. I would say we always keep some extra capacity because CDMO business is a very strong business as of today in India for us. So we will keep some extra capacity, and therefore, as we have announced in our capital investment plan, if you see, we have one more large CGMP capacity to be approved, which we will do as soon as we realize these volumes which we will build up this quarter. So it's an ongoing. We are keeping a very close watch on the demand and take a decision promptly to add capacity.
And one last question on this. So will it be possible for you to tell us what contribution within the specialty chemicals is driven by the CDMO business currently?
As we have been telling that it is in the, let's say, close to a double-digit percentage of our total specialty chemical revenue, which is now going to improve significantly when these pipeline products will come in.
Okay, sir. Thank you, and wish the team a very happy Diwali.
Thank you.
Thank you. The next question is from the line of Tarang Agrawal from Old Bridge Capital. Please go ahead.
Thank you, sir, for the follow-up. Just two quick questions, sir. One, if I look at your specialty chemicals business and assume the COGS to be only raw materials and power and fuel, typically what would be the ratio between raw material and power and fuel in your COGS for specialty chemicals only, which is pyridine and pyridine derivatives?
So if the cost is 100, our power and fuel will be in the range. So it depends on the price. Like right now, it will be in the range of 15 to 18%. Usually, it should be 10 to 15%.
This is power and fuel raw material, correct?
Yes, yes. And this is 10 to 15% of the cost of the product, not on revenue part.
Correct. Yes.
Yeah.
And second question, sir. I mean, the impact of coal, at some point you alluded to about 140 crores for H1, and
yes.
to the other participant, you mentioned that in Q1 it was 40-45 crores, and in the second quarter it was roughly 50-55 crores, so 100 crores. So I think I'm a little confused here, sir.
Yeah. So I explained this, now I explain again. So the impact is two part. One is the specific to us, that is FSA part. FSA part is almost 140 crore for H1. There is additional cost increase of coal, which is for everyone. The last year the price was 6,000 rupees a ton. Today it is 12,000 rupees a ton. That is additional impact to us to the tune of 70-80 crore, but that we have already passed on in our pricing. So therefore, you just for your understanding, you just count this 140 crore. Forget the other number, because other number in any way we are taking it, passing on to our pricing.
Got it. Much helpful, sir, and wish you a happy Diwali. Thank you so much.
Thank you. The next question is from the line of Bajrang Bafna from Sunidhi Securities. Please go ahead.
Yeah, thank you for the opportunity. So, sir, my first question pertains to, as you have pointed out in your opening remarks, that you are parallelly working on some, buffer in terms of going to alternate energy sources. And, I have been tracking a lot of companies who have already entered into, solar contracts on OPEX model for next 25 years at a rate of close to 5.5 to 6 rupees. And without investing a penny, that is something which is available to your competitors also, in the northern market. So are we thinking something on those lines? And if yes, by when we can expect, this to flow to us, and what percentage we are targeting to, let's say, migrate from, this coal-based sourcing to, let's say, the renewable or the solar power energy sourcing, because it fits in our, green theme as well. So if you could highlight that, will be really helpful.
So first thing is that you are right. Solar is one of the source which we are very seriously working on. And we already have started solar sourcing in one of our sites, that is in Maharashtra. We are working very seriously to start in Gujarat. We are working very seriously to start in UP. So you are very right. That is one of them. Now your second question, what percentage? Now, as you know that we are generating our own power in Gajraula, and we plan to generate our own power in Bharuch. Now, to that extent, this cost will be cheaper because we will be generating our own power. If we consider all that, our solar percentage let me give you this number a little later, but just be rest assured, we will be doing the best possible solar combination in our energy sourcing. And you must have seen about 2 or 3 quarters before, we have made an announcement with that NERA sourcing. So obviously, gradually, as and when we proceed towards the maturity of this discussion, we will bring it up to you. We will inform you.
Got it. So maybe in FY24 we will have, certain portion which will be coming.
Okay, sorry, I missed that point. So on timing, you are very right. Give us about 9 to 12 months. I think we will be very clear and matured with our mix of energy sources.
Okay. And sir, my second question pertains to, your specialty business. If we try to understand it like we are, as and when we are able to get the coal cost under our control, we'll be back to 20% plus margins, and we are at a base of, let's say, 1,500 crore kind of top line. So now we have earmarked, Diketing, where we are targeting 100% utilization, probably by the end of this financial year. Then we have 2 projects in the CDMO and the multi-purpose CDMO which are going to be operational. So with this, immediate near future, maybe in next 12 months perspective, where do you see this 1,500 crore base will shift? I know that you have already given a long-term target of 9,500 crore top line by FY26 and close to, let's say, 18-20% kind of margins. But if we want to model in for, let's say, FY24, where this base you expect, because you are already entering into, some certain near to long-term contracts. So what is the visibility, on the revenue side will be really helpful.
So if you see the revenue side visibility, it's very clear, as we have been saying every time, that whatever we are making investment. So let's say we have announced 900 crore investment already committed. As and when these capacities will come on ground, we will give return of this asset investment to the close to 2+. So that you can keep adding very, very clearly. So as and when we bring the capacity, that revenue, it takes about a year time to bring the capacity utilization to the tune of 70 to 80, 90%. So that time, if you give that revenue, keep adding. On our volume performance, obviously these capacities we are bringing based on the requirement of existing product as well as new products. So just to be rest assured that as soon as the capacity comes, in few quarters, the capacities are really utilized to a optimum level. So that should not be a challenge.
So I know, sir, this is, sort of diplomatic answer, but just to be precise on the number side, can we expect, let's say on the base of 1,500 crore by the end of Q4 of this year, will be at least, 15 to 20% higher, and maybe next year again we can build up this kind of growth, especially on the specialty business?
Very difficult to give these guidelines, because most of these revenue numbers I am really hesitant to give guidelines, because revenue is impacted based on the input prices. So, but we can definitely give guidelines on volume. So as I said, as soon as the capacities come, we will utilize the volume. But what happens to the raw material price, I don't know. If you have any model, please let us know. We will be building up. But at least we don't have any model, because raw material prices are changing so drastically, like methanol is changing, acetic acid is changing. So like acetic acid last year acetic acid was $1,000. Today acetic acid now is sitting at $550. So how can I give guideline on the revenue?
No, sir, you can tell us volume will also be okay. We don't mind even getting that.
Volume, very clearly I told you, as much investments are coming, those volumes will be in 3 to 4 quarters will be utilized. Every investment we are making, once it comes on ground, we give a return of asset investment to the close to 2+. That will happen.
Got it. And just my last question on the B3 side. Yeah, just on the B3 side, can we see the stabilization of business from this quarter, or still we might take 1 or 2 more quarters to get it stabilized?
I have said it in the last question. If somebody asked the same question, I said the normalization we can expect, full normalization we can expect Q1 next year, but things are improving. This quarter volumes are improving. Next quarter further volume will increase, but full normalization will happen in Q1 next year. Having said so, the overall normal situation you will see in Q1 only, because It will take time for inventories to liquidate. It will take time for demand to come to the normal situation. But things are improving. So from last quarter, this quarter is improving, and of course Q4 will also improve. But normal situation, we are very hopeful that Q1 next year should come.
Okay. Thank you very much, sir, and all the very best for good coming quarters. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference back to the management for their closing comments. Thank you, and over to you.
We thank you all for joining this call today. We hope we have been able to answer your queries. For further clarification, we would request you to contact our investor relation team. Thank you once again for your interest in Jubilant Ingrevia. We wish everyone a very happy and prosperous Diwali. May the coming days add warmth and joy to you and your family lives. Wishing safe celebration to you all. Good evening.
Thank you very much. Gentlemen, on behalf of Jubilant Ingrevia Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your